And a happy quadruple witching day. So part of the reason that we do see more volatility, more volumes on this day is because investors have to close out some of these contracts that are profitable. And there actually are a lot of arbitrage opportunities that arise because of this. So a lot more trading, which you can see in the yellow circle. So just to give you an example of this, the December one, that was 15 billion shares that traded on the S&P 500. That's 85% above a normal day that we see. I want to switch up the boards, though, because this also has consequences for the following 5 days. Typically, we see declines because some of the near-term demand does diminish with these contracts closed out. So take the Dow here, an average decline of 1% the following week. 25 out of the past 29 years, we've seen declines, even though some of these indexes aren't as much. But if that wasn't enough for you, Anna, there's also another reason why we get some volume, some volatility in the stocks. I have another chart for you here, and that's because the Dow Jones indices, they need to rebalance the S&P 500 about once per quarter, depending on what market shares do. And they have before the Monday open in order to do this. So I have some of the biggest changes on the board. Look out for Apple. That is a decline of about $20,000 per S&P 500 share. Algos will also try to front run this. Passive funds need to reflect this change. So really, when we look at trading today, we need to know that there are structural things that are affecting the trading. So don't assign too much fundamental reason for any oddities that we see, Anna.
Hey Alpha fam, welcome back to another episode of Alpha Commission. Today on Alpha Commission, of course, we are going to go over the sea of red, that just blood red on the crypto charts, as liquidity is being drained from this market, and as fears of the Federal Reserve meeting coming up on September 21st do linger over us after that terrible CPI report, which basically is having the entire market scramble for new math as how they could calculate the possible downside. And so you do see after that, just a horrific day the other day, one of the sharpest downturns in the market that we've had in several years, I believe. We did have a temporary bounce of just a little bit, and then we are basically taking that back as the market does contemplate testing its lows. So let's go ahead and just check out what's on the economic calendar over here. Of course, it was Thursday, September 15th, and we got a whole bunch of jobless claims data. You can see that jobless claims are actually significantly lower than what was expected. Again, just underscoring that the market remains robust, at least in the sense that we're talking about the Federal Reserve needing to cool it off. I'm not saying that we're not in a recession. I did mention several months ago that probably we would tip into a real recession, right? Quote unquote real recession. Now that we're all using slightly different definitions of that term, right? We would tip into a real recession coming into 2023, and we would start to feel its pinch in quarter four, 2022. And as we start to say goodbye to quarter three, 2022, we are going to start feeling that pinch of the recession, and we are going to see a lot more conflict between the individuals highly focused on, interest rates and the stock market and inflation versus the people, highly focused on globalization, free trade, basically the gross domestic product, and how deep the recession is and what type of shape it might take. And their interest, these various different camps, they aren't necessarily going to be looking for the same thing. And as we get muddled into that kind of stagflation scenario, where first we were talking about inflation and there was a possibility to separate inflation from recession, now we have this weird overlap, and there's just no easy answers during this time, which is why the Fed was warning the market, that they're not going to pivot, right? They're not going to pivot, and that's why the market came smashing down as the market started to realize that, yeah, the conditions aren't there for the Fed to pivot, and so now we're starting to price in, the possibility of 100 basis points increase, which of course the Fed always uses ranges, so that's really 100 to 125 basis points. Previously, we were talking about the difference between 50 basis points or 75 basis points, but now the debate is between 75 basis points and 100 basis points, each with a range of 25 basis points of flexibility additional tacked onto the back of it. And so the market is seeing the potential for not only 100 basis points increase in September, but also the possibility of adding an additional unforeseen, unwanted 50 basis points in December. And there is quite a lot of conjecture, quite a lot of rumors, quite a lot of hypotheses going on out there about what the Fed is thinking and what they are going to do. Some people are saying that Jerome Powell is going to invoke his inner Volkner, having realized the error of his mistakes during the Trump administration, where, of course, Jerome Powell was hired by Donald Trump back in the Trump administration, and he just basically printed unlimited money. He gave basically 0% interest on any loan that any billionaire, any millionaire, anyone with great credit would like to have a loan. They got a loan, which is an extension of money, which is basically monetary expansion. It's basically printing dollars. So unless those loans are repaid or defaulted on, the monetary supply, right, increases exponentially. That's on top of what the government is, spending in terms of deficit or printing, and so that kind of hidden money printing that goes on in the private sector related to banks surrounding the interest rates. Of the Federal Reserve, of course, 0% interest rates means they can print infinite money. And during COVID, during the Trump administration, it was just an infinite money printing machine. And now Jerome Powell says, "Oh, guys, I'm sorry." Of course, he doesn't say sorry. I realize the error of my ways. I'm going to be a good boy now, and I'm going to tighten the conditions. I'm going to retract all of that money. And so what they are doing is they are selling bonds, which basically means, people pay for bonds in dollars, and so dollars come into the Fed, right, as they sell these bonds and other things. And so what happens is that the Fed's going to hold on to those dollars, and so those dollars are taken out of the monetary supply. So inflation goes down because there's less dollars in circulation. And so if there's less dollars in circulation, each dollar is worth more. And so inflation decreases a little bit every time they do that. Every time they quantitatively tighten, they shrink that money supply, and dollars just to gain a little bit of strength, right? And then, of course, by increasing interest rates, they make it harder for banks and for private entities, right, to extend loans. It becomes much more expensive to extend loans. Joe Billionaire, right? Trump's buddies, Pelosi's buddies, they can't just go out there and get a 0% loan for $1 trillion anymore, right? And do whatever they want with it. They can't get a PPP loan, right? Anymore, and not have to pay it back because for some reason we let all these millionaires and billionaires get PPP loans, right, for their businesses during COVID, and none of them, not a single one of them, paid it back. And so that's trillions of dollars in the monetary supply, which is just out there circulating, and there's no way to get it back unless you tax those people for any windfall profits that they got. unless you tax those people for their income. But of course, Congress is at a they're at an impasse on taxation, and so they can't recover those dollars. They can't bring the dollars back into the Fed or back into the loan making machine. And since they're unwilling to tax, right, those millionaires and billionaires who took loans and didn't pay a single penny back, so guess who gets to pay it back? You pay back the loans of all those businesses, of all those billionaires who got PPP loans. And guess what? If you, even if you aren't paying taxes, you're still paying for it in the form of inflation, because everything that you need to buy, from food to rent to whatever, is now going up in price because of that monetary expansion. And that's basically the issue, right? That's the issue with all that COVID money just driving a big bubble, as all these speculators, all these wealthy speculators, everyone who, got a nice check during COVID, probably not the poor people who are using that to pay their rent and, to buy food, but the middle class, they suddenly had an extra $1,000 to speculate on crypto with. The upper middle class suddenly had all these hundreds of thousands of dollars of business loans that they got with 0% interest. Many of them didn't have to pay a penny back, right? And so they're like actually doing fraud left and right, like just outright fraud, right? All these friends of Trump and Pelosi, these kind of corrupt, like just, high on the Federal Reserve cocaine, billionaire and multi-millionaire, circles, just basically, just taking that monetary supply and doing whatever they want with it, as if it was free money, as if we, the people, didn't have to pay for it, in the form of hyperinflation, which is the result of those policies that came from Jerome Powell and Donald Trump during the COVID era, right? $9 trillion when all is said and done. $9 trillion. And guess what? All of that was a bubble. It was fake. It was fraud, okay? It was theft. It was outright theft. And now Jerome Powell sees the error of his ways, and so he wants to bring that money back in. And so he's hiking up interest rates to force people to pay back their loans, to force people not to extend more loans, right? And to also make bonds more attractive for buying so that he can bring dollars back into the Federal Reserve. All of this makes the dollar stronger, right? Which then, actually is causing other problems around the world, as of course many countries use the dollar for trading, and they are just being oppressed by this. And so sometimes the interest of a country, that is the foreign reserve currency of the world, doesn't align with the interest of all the countries around the world that use that reserve currency. And we're seeing, the incredible stress that it's putting on Europe, the incredible stress that it's putting on Japan, who, by the way, have their own national problems. They've been doing like much crazier stuff than the U.S. actually. So that's on them. But the dollar just adds to it. It's like putting your thumb on the scale, tilting it in a direction which for Europe could be a depression. And so to solve these things, the guys who want to fight inflation, they're saying invoke your inner Vulcaner, right? Jerome Powell, increase interest rates as high as possible. And so right now, about 25% of the population of the market believe that Jerome Powell will be increasing 100 basis points at the next meeting. And 75% believe it will be only 75 basis points. Let me get a sip of my tea here. And so think about it. If Jerome Powell ends up increasing rates by 75 basis points, then we may get a little bit of boost or go sideways. But if he increases it by 100 basis points, there are going to be 75% of the market, which is just shocked. And so the market is going to drop like a lead balloon. Okay. Tomorrow we do have the University of Michigan Consumer Sentiment Index. We also have their 5-year consumer inflation expectations. These things may give a little bit extra information to the Fed, but pretty much everything's baked in from all that CPI data that we got earlier in the week. And then, of course, next week on the 21st, we should be hearing from the man, the legend, the global thief himself, Jerome Powell, when he gives his news conference and the result of the Fed meeting. So just understand that between tomorrow, which is a quadruple witching. Okay, guys, it's a quadruple witching, as you saw on the intro of this show. So between tomorrow and the 21st, just expect a lot of volatility, and then usually there's a little bit of lingering volatility as the market just kind of absorbs the news and decides, which direction it's going to take, which probabilistically, would be down, and also likely to be down after the witching, right? After the witching tomorrow. So that's just based on probabilities, okay? Let's go ahead and take a look at the charts. Of course, we did have a major fall on Bitcoin the other day, Tuesday, and basically every market had a fall like that. And so, a lot of people are trying to speculate that we should pop up and kind of fill out this naked candle. And, if we could get more than halfway up, then maybe we could reclaim that level that we lost, but just everything looks pretty terrible. On a quadruple witching, we can see, just a tremendous amount of volume. So, in these low liquidity markets, who knows what's possible? But if you're swing trading, it's probably not the trade to take. If you are just a kind of sniping certain levels, on the 15-minute, maybe you can keep up with stocks, but it may be a little bit wild. Just traditionally, it's pretty wild. If we look at the stock market, right, the S&P 500, we can see, of course, that we are basically breaking down from that support that we put in on September 7th. And it does look like we're probably going to challenge our June lows. Okay, so we're pretty much breaking into that zone as we speak. Okay, we are facing this kind of breakdown, and the line that the market would like to defend is 3,900. We're already at 3,885. Okay, guys, so they're not doing a very good job at defending it. Let's go to the 1 hour. And by the way, I am on the S&P 500 mini futures, and so that's why this is continuously updating. But we do have this very weird little CME gap. Usually we don't get these CME gaps on the on these kind of continuous charts, but we do have a little gap here, which lo and behold, it's at 39 05. And so if the market makers on the S&P 500 actually are trying to keep the price around 3,900 in order to not experience a lot of losses on their options, as the witching, right? The quadruple witching is the closing of all those options, all on one day. We could see the market push back up to 3,900. So we could actually see the market push back up to 3,900, exceed 3,900, make a run for maybe some of these levels, like up here, even like 3,940, right? 3,960. Maybe, this thing could pump, and probably Bitcoin would pump along with it. But then ultimately, you would probably find that the market makers would drive it back down to 3,900 because they don't want to lose money in either direction. This is the max pain, in the market right now for the S&P 500, and so this level may be, defended quite strongly, and so you could see a lot of yo-yo action. You could see just, unexpected volatility, and if we do break in one direction strongly, it could be game over for the market makers. The market makers don't always win, guys, right? Like, we just kind of assume that we're going to end up at the max pain point, but we could end up just breaking down, right? When some of this math starts breaking decisively to one side. So just watch out. The quadruple witching isn't necessarily for the faint of heart, and you just may want to understand this may not be a typical trading day, and things could get a little bit hairy. Let's go ahead and take a look at the VIX. Yeah, I mean, look at this jump in the VIX, man. Like this, the VIX just like, look at this CME gap. This is the CME gap on the VIX. What the heck is that? That's not a gap. That's a territory. Okay, that's a CME territory. All right. So and this is the triple witching, right? Like this is the triple witching. So you can see this a gigantic increase in volatility, and that just tells you, what could go on today. All right. So be aware. Be aware. All right. Guys, let's see. Let's jump over to the dollar. Dollar continued to push up above my kind of scary line up here, right? Which I had called when we were way down here, and I set that as kind of the limit, right? There was a CME gap here. We ended up filling it, and then what made it scary, I turned it purple, which is my normal CME gap color, to yellow, because what would be scary is if we held that CME gap as support and then actually pumped off of it. And lo and behold, look what happened. We held it as support and pumped off of it. So, you guys know me. I was trying to set up the bullish conditions, and I just had to keep calling the negative conditions, and the negative conditions keep playing out. I can't fight the market. Of course, the dollar index does have this kind of exposed, candle to the downside over here. So maybe this thing could BART down at some point, and maybe that's going to be part of all this volatility. But overall, looking extremely bullish and threatening to retest those 110 highs, at least on the capital.com TradingView chart. There are several DXY charts, and some of them have different indices. So just be aware that different dollar charts have different prices. Let's look at the USDT, and you can see that people are just fleeing crypto, right? We're at this resistance point. It's very hard for the market to pull more money than this out of it. It's kind of like how Bitcoin is defending a line. Well, the kind of, same thing with USDT dominance. The people who are defending the line obviously have their money in crypto, and so it's only if that line breaks that this thing is going to spike up. And so we may see that happen today, or perhaps into the week leading up to or immediately after the Fed's decision on the 21st. So nice and volatile week that we have ahead of us, guys. Those are basically your those are basically your risk factors there. Let's take a look at Flux. I did call this thing to the downside, and yeah, I mean, just, you know, I mean, I said take your profit up here, and then we bounced up here, and I said take your profit up here if you haven't yet, right? And so if you didn't, like, well, what did we drop? Like, we dropped, 15%. So, I mean, I know it's tempting to just ride things out, but, wouldn't you, if you made, right, let's see, where were we calling it? We called it down here. You see this green box right here? That was our first buy on this asset, right? And if you made, 40%, wouldn't you want to keep that 40%, right? do you want to lose 20%, right? I mean, and then you had another chance to get out. So, you guys, I mean, this is why I trade, right? Like I trade because it's better to keep your profit as opposed to lose it, and then the market dumps, and you end up, coming all the way back lower than what your entry was, right? So, of course, if you got in down here, which just had just a gorgeous, pristine, like that's the dream entry that everyone wants. Like the setups on all of the indicators were like just screaming, go into this. And, of course, I didn't see it. Most people probably didn't see it. There's just so many coins to look at. But, if you didn't get there, then, just understand this thing is quite extended and it may want to just settle in a bit. And if Bitcoin does lose a level, then this thing will probably lose a level as well. CRV just holding on to my wedge, doing nothing too interesting. I mentioned it's kind of a safe area to, just count this as support just based on history. But, this thing has a continuation to the downside, right? This kind of equal, triangle here, and it has it came in with downward momentum, and those type of triangles do tend to break to the downside. So just if you're playing a bounce like on a short term, that's what I'm saying. I want to see CRV up here, but if you're just playing a little bounce, I mean, it's up to you if you're gonna use stop losses and stuff. It's just a very risky play. This is also just a rectangle, so it's not really a triangle, but you can understand that this is like a kind of a bear flag, right? I mean, this is in the middle of this range. So we're just monitoring this. And by the way, guys, the reason we're monitoring this is just because it's so close to a good daily setup. Like like if it can just get into this area and hold it like above this wedge and just hold it for like a few days and start squeezing, then, we could play this up to 160, but it's just not there yet. That's why we're just monitoring it. And I'm not really advising anyone to get in on this or anything, right? I'm just mentioning, like it's playing out this kind of wedge, it's playing out this kind of rectangle. I should probably just make it a rectangle. Let's see here. ADA, same thing, just holding its level, right? It's kind of this green level that I have down here, right? Still has this nice rounded bottom, hasn't violated anything. It looks okay. I mean, like if the market ever turns bullish, like this thing would look pretty good actually. But I mean, I wouldn't enter unless we had like clear signs from the rest of the market. KDA, this one's looking sloppy. It's looking like it's breaking down, guys. So this is what I was mentioning when we were looking at ZIL, that something like what happened to ZIL could happen to KDA, and it looks like it's happening. It looks like it wants to explore the bottom of its range, maybe the bottom of this wedge. You know, um, who knows? But again, like it just wasn't in a pretty spot to be buying in at, so that's why I didn't recommend to buy in. Once we violated this diagonal support, right? Get back up over 165, and I'm a little bit more interested, right? Let's see here, ZIL, same story, right? It already broke down. Like this is my fear for Kadena, but ZIL could just do the same thing. It's kind of like working its way down there. Obviously, some whale front ran the dump, right? So some whale believed that this thing was going to dump coming into the Fed decision, coming into the quadruple witching, right? Coming into the CPI data or whatnot. Or I guess that was probably CPI day. And so they just dumped everything, and ZIL just completely lost a level, right? So is the rest of the market going to follow it down? I don't know. But this is the threat. Like everything is threatening to test its previous lows. ZIL is kind of showing us what can happen. That can happen to Bitcoin. That can happen to ETH. That can happen to basically all of these assets. If the stock market does lose a level, then probably crypto will as well. Let's go ahead and take a look at ETH. I did kind of just bypass it. I didn't update its momentum zones here, but it doesn't matter. It's going to be underneath everything. So just take this with a grain of salt. It'll be pretty similar, but could be a little bit fine tuning from the other day. Let's see. I mean, it's just continuing to look sloppy. It is at a little bit of this kind of support zone in here. It does have some exposed candle. If it does pop back up, that would be kind of a bearish retest of this neckline that we can clearly see starting to play out, right? That kind of neckline that I had suggested might play out. We did lose it, and now it, has the possibility to retrace it and then continue to break down as it probably challenges this level. Again, we have a CME gap on ETH, right? At you can see this gap right here in the chart. So we have a CME gap at 1340 all the way to 1290. So 1340 to 1290, right? So right there. And, if it fills in that gap, I honestly consider this not to be the most bearish thing in the world. Wow, you can kind of see like it's doing the same thing that Kadena and ZIL are doing, right? Like retracing back down to the apex of its wedge. Let me see, is that what Bitcoin's doing as well? Yeah, Bitcoin also had that wedge, right? It had that falling wedge that I've been talking about for weeks. Boom, right there. And it just like everything is just falling back to this wedge. Like, Bitcoin did get the measured move off of the retest, but for this to be bullish, it should have gone up here, like just it should have been bullish, but it was just so bearish, it just could. But it did do the measured move, I guess. I'm not sure how a sloppy breakdown is measured, but I mean, it doesn't suggest any. There's no other pattern to really suggest it to go higher. For ETH, there was a couple patterns that did suggest for it to go higher. Not only did its wedge suggest it should hit 2000, there's also some harmonics, and then there's some other patterns that we were talking about, but they're just not playing out. So just it's a moot point. We are seeing more of the breakdown. We are seeing more of this kind of sloppy head and shoulders kind of thing. Anyway, this kind of like rounded top kind of thing, just distributing over the side. And so, this thing might threaten to break the next level down and fill in that CME gap perhaps, right? And then we'll take it from there. Guys, gonna cut this one short to 30 minutes instead of the usual hour. Hope you appreciated that. And of course, tomorrow is the quadruple witching, so it's gonna be highly volatile, guys. Like this is a very volatile month. Okay, so just take it easy, preserve your capital, don't get stressed out, do your best, and that was your alpha for the day. So stay safe and happy trading.